Hey guys, welcome back to another video. I hope you guys are staying safe, staying loaded, and if you're a reefer operator, you're getting those produce loads and making some money as much as humanly possible in this market. Today we're going to do another weekly market update and forecast where we look at what happened to the market last week and what we can expect next week. Now, if you're new to my channel, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis. So if this is a topic that interests you, feel free to subscribe down below. All right, guys, let's take a look at some data to figure out what in the world is going on in the freight market. Ready? Let's go. Now, before we actually go to the board, a quick announcement. This Sunday at 4:30 p.m. Eastern, I'm going to be doing another live Q&A. So if you have any questions about the trucking industry, the freight market, or anything related to trucking, you know where to find me. All right, let's get into some data. All right, guys, as always, we're going to start with the outbound tender volumes versus outbound tender rejections. As a reminder, outbound tender volumes, the blue line right here, I know it looks all messed up right now because of the lines, but I'll explain them in just a minute. This is the total amount of freight on the market. This is not the spot market, this is the total. Now, in terms of the white line, if you can see it between these bars, that's the outbound tender rejection index. This is how much freight, specifically contract freight, is getting rejected and therefore trickling down to the spot market. Now, another quick reminder, usually tender rejections correlate heavily with spot market rates because the more loads are rejected, the more volume ends up getting pushed to the spot market. And when volume starts getting pushed to the spot market, provided that capacity does not increase in the same period of time, of course, the spot rates will start increasing because that load to truck ratio starts shifting to the carrier's benefit. Okay, let's take a look. Again, ignore these lines just for now. I will attach all of these charts down below. They will be clean, so you'll be able to see this a little bit better. But basically, what we can see is that the outbound tender rejections, this is June right here. Outbound tender rejections since June, if you take a look, they went down, and since around June 12th, which is last week, they have been climbing up. And currently, they are at 3.43, which means that 3.43% just about is getting rejected and most likely trickling down to the spot market. Now, at the same time, we can see that volumes from around June 5th, they skyrocketed after Memorial Day, and then they were on their way down. Just over the past day or so did they start slowly recovering. Now, why did I divide this chart? If you can see, we have numbers here. This chart is divided into weeks. Why did I do that? To show you the correlation between the volumes on this chart and the volumes on the spot market, right? We have week 17, 18, all the way through week 24, which is last week. Now, we also have this total spot load availability, and we can see that I also put in week 17 through week 24 here. Now, this is not my chart. I just put in the numbers. This is a chart by FTR Intel, but let's compare. So from week 17 to 18, we can see load volumes declined. We can see that load volumes declined from week 17 to 18 here as well. From 18 to 19, the load rates stay pretty level, which is something we can see here as well. I mean, there was a small increase, but pretty level. Now, what does not correlate, and this is something that perplexed me, is week 20. We can see that from week 19 to 20, spot volumes actually increased. But from week 19 to 20, there was no real increase in the general freight volume. And on top of that, we can see that the tender rejections from week 19 plummeted down, and as of week 20, they started increasing. Maybe this is what happened, right? As tender rejections increase, so do volumes that go to the spot market. So even though the general volume did not increase because more volume was pushed to the spot market, that's where we can see it from. Now, usually I say, and I'm going to repeat myself here, I say that tender rejections, they're correlated strongly with spot market rates because as tender rejections go up, so do spot market rates, like I explained in the beginning. But yesterday I made a video for my Patreon. It's called Key Market Movers, where I explained this phenomenon. It's not always going to be the case where tender rejections and spot rates are moving in the same direction, because it also depends on volumes. To give you an idea, let me give you an example. Let's say you have 10,500 loads and the rejection rate is 2.9%. Well, that means that only 304 loads are hitting the spot market just about. Now, let's say the rejection rate is 3.5, but the total amount of loads is 8,500. So the volume dropped, but the tender rejection rate increased. Well, in this case, there would be 297 loads going to the load board, so less than in the 2.9% rejection rate. So volume has a lot to do with what is going on the spot market. Yes, tender rejections give us a very good idea, but without volumes, tender rejections really don't mean much. Now, I'm sad to say that even though we have such good news here that tender rejections are climbing, what we are really seeing is that this does not translate to the spot market at the moment. So let's take a look at the National Truckload Index for line haul only. As a reminder, this is data collected from dry van operations. And what it shows us is the spot market rate without fuel surcharge. Now, what we can see, again, reminder, as of around June 7th, I would say, the tender rejections started climbing up, and they have been climbing up ever since, which is great. But if we look here, let's see, where is June 7th? Well, June 7th, we can see that the spot loads, they did have a peak, but since then, regardless of the fact that tender rejections have been climbing, spot rates are actually going down. And currently, the average spot rate without fuel surcharge is $1.62 per mile. So what could be the cause of this phenomenon where tender rejections are going up, but spot rates are going down, provided that volume, it actually, yeah, it's lower, but it's actually still higher than in the beginning of May. So realistically, the spot rate should not be decreasing. Well, I have two theories happening here. Number one is very often tender rejections will predict future spot rates. So tender rejections happen before the spot market reacts. And we're going to see this in just a minute. So it's possible that tender rejections are going up right now, and we will see that effect only maybe next week, maybe the following week. God knows. Number two theory, contract carriers. A lot of contract carriers have new contracts which reflect the current market, unlike it was before, where it reflected a more favorable market for carriers. So theory number two is that contract carriers are rejecting the contract freight. They don't like the rates, so the rejections are up, and contract carriers are actually turning to the spot market to book their loads. So the capacity increases. So in that case, rates are up in tender rejections, but also at the same time, the spot rates decrease because of the increase in capacity. Now, obviously, I'm just speculating. I have no solid proof of what is happening. So if you guys have any ideas, let me know in the comments. Now, because when I don't know a clear answer, I become obsessed. I must have an answer for everything. I decided to look at these two charts. The first one compares the National Truckload Index for line haul only, spot rates without fuel surcharge in blue, to the outbound tender volume. So again, white line is the volumes, the blue line is the spot rates without fuel surcharge. So when I looked at this chart, yes, we can see that volumes and spot market rates, they move in the same direction. But to say that there's a strong correlation between the two, I wouldn't say so. There's more of a correlation between spot volumes and spot rates, because that directly affects the load to truck ratio. In this case, not so much. So let's take a look at the NTIL, the spot rates without fuel surcharge, compared to outbound tender rejections. The spot rates are in blue, rejections are in red. We can see that rejections skyrocketed before the spot rates did. So this does happen, and I'm hoping that this is what is happening right now. Rejections are on their way up, so the spot market will follow. But currently, we're in a very strange situation where rejections are on their way up, as you can see. If you can see that, yeah, you can see that. And the spot rates are down. But we're going to see what is going to happen in the next few weeks. But yeah, this makes me very nervous that I don't have a solid answer as to why this is happening. So why don't we move on before I drive myself and you guys insane? Okay, finally, we have the spot to contract rate spread. And we can see that this week we are at 78 cents per mile, which means that contract rates pay on average 78 cents per mile more than spot freight. So yeah, the gap increased as of last week. Last week it was a 76-cent difference. So we're going to see what happens in the next few weeks. All right, now on to specifics, starting with flatbed. So first we have the spot loads. How much volume is there on the spot market for flatbeds? Well, we can see as of week 24, this is last week, volumes have dropped, and I can tell you from personal experience, I feel it, I see it. It's much harder to book loads because there's less volume and there's either more capacity or the volume just dropped so much that there is enough capacity to cover all those loads. There is not as much negotiating power today as there was, let's say, a month ago. So that's what's happening with the load volumes. In terms of the load rates, so I have some unfortunate news here. This is the first time, for those of you who don't know, the black line, this is the 5-year average. These two lines are prior years and the blue is us right now. This is the first time for flatbeds since the beginning of year where we are trending below the 5-year average when it comes to spot rates. And actually flatbeds fell by 5 cents from week 23 to week 24, which is a huge drop. So as you guys can imagine, I'm not having a really good time booking loads as of right now for my flatbeds, but it is what it is. We push through it. All right, so now let's take a look at where we have to go with the flatbed, where the negotiating power is going to be better. As a reminder, we're just looking at flatbed, and we're looking for something or states where there are more loads picking up, more volume than the loads dropping off. So more loads than trucks. In the western states, California, Nevada, which is new, Oregon, Washington. In the plain states, it's only Oklahoma. In the Midwestern states, Minnesota, Ohio, and West Virginia, which is cut off there. In the southern states, Alabama, Arkansas, Florida, Georgia, Louisiana, Mississippi, South Carolina, Virginia. Yeah, the South is still a good place to be for a flatbed, or relatively better than everywhere else. Northeast, Delaware, and Maryland. And of course, for my visual folks, here is a map showing the same thing. The darker an area, the more negotiating power, more loads than trucks. We can see that the South is the place to be. Yes, on the West Coast, there are also opportunities, but something you have to remember, and I say this all the time, if you go to the West Coast with a flatbed, the best rate per mile will always take you to the West Coast. And to get out of the West Coast to the South or even to the Midwest is going to cost you. All right, now on to the dry van, starting with the spot volume. We can see that there was a smaller decrease than with the flatbed in terms of the spot volume, but still the decrease was there. And the worst part is we are no longer following the 5-year pattern, right? Instead of going up in volume, we are going down. If we take a look at dry van rates, spot rates, we can see that they have been decreasing over the past 3 weeks. And there was a nice decrease here as well. But here we are more or less following the 5-year pattern. Although it looks like we should have plateaued as of week 23 and then went up, we shall see what happens next. But yeah, way below the 5-year average, obviously, but again, we'll see. We're hopeful, right? Hope dies last. Let's take a look at some market maps, starting with the volumes. As a reminder, the color of a market area tells us how much volumes change and in which direction, right? If it's red, and the darker red it is, the more volumes dropped. If it's blue and the darker blue it is, the more volumes increased. The height of an area shows us general volume this week in that area. So the higher it is, the more volume. So for dry vans, we can see that it's mostly gray and red, which means gray is no change, red means a decrease from last week. There are some markets where volumes did increase, like Nebraska, South Dakota, there's the the Odessa Midland market, some parts of Arizona, but these markets are flat, right? Even though volumes increased from last week, it went from one load there to two. So not a good market to be in. Now, there were some increases. Michigan looks interesting. There is a nice amount of volumes for dry vans there and increased from last week. But let's take a look at tender rejections. So this map works in the same way. The color shows us which way the tender rejections went since last week. Blue means they increased, which is good, and red means they decreased, which is bad. Gray means no change. And the height shows us the general tender rejections in that area. So I was surprised to see that actually Nebraska has a nice amount of tender rejections and they increased from last week. We can also see in the south there are some increases, but also in the north. In the north, it looks like the place to be. Everywhere else, except for maybe Virginia and portions of North Carolina, Idaho, Montana, everywhere else it either stayed the same or it decreased. But we'll take a look at where are the best places to go if you have a dry van in just a moment. But before we do that, let's take a look at the head haul map. So blue means that there are more loads than trucks. It's just like the flatbed map that we saw. Red means there's overcapacity, no negotiating power. There is a nice amount of blue in the south, in the Midwest, portions of Pennsylvania, California, but everywhere else it's overcapacity. I would say that for dry vans, the capacity issue is getting better. There was a time where pretty much the whole map was red. So it looks like it is getting better, but very slowly. So where do you have to go if you have a dry van? Now, as a reminder, this map shows us rejections versus volumes. Rejections are the colors. The darker blue, the more rejections. The height is the volume. And what we want to see is a place where there's a ton of volume and it's as dark blue as possible, because that means there's a balance. There's a lot of volume, a lot of it is getting rejected, and therefore a lot of volume is ending up on the spot market. Now, usually I would just rush into it and tell you exactly where to go. But this time, because of the cluster, I'm not going to say it, you know what I mean. I decided to double check to make sure it's not like a whole mess, with tender rejections and volumes and the spot rates going down. So I did double check. Starting with California, Southern California right here. Yes, on the load board, a ton of freight coming out of Southern California for dry vans, and the rates are wonderful as long as you're going to a place like Washington, Oregon, Utah, Idaho, basically the West Coast. If you're trying to get out, the rates are not so wonderful anymore, but I will tell you that the rates have vastly improved, as have the volumes since we quit our dry van, which was 3 months ago or so. So California, yeah, if you want to get stuck in the West Coast, you can run for a good rate per mile. Fort Worth, a decent amount of loads and good rates if you're looking to go to Utah, New Mexico, Pennsylvania. But if you're looking to go to a place like the Midwest from Fort Worth, you're looking at $1.50 to $1.80 per mile. So not so great. Louisville, Kentucky right here, super dark blue, not a ton of volume. Yeah, not a ton of volume. There is something to choose from. Great rates going to the northeast, but that's pretty much it. And then we have Wisconsin, which is also super dark blue right here. And this pays very, very well going to the northeast. But if you're looking to go to a place like California, you're looking at $1 per mile. Now, just to test the theory out, I decided to, because I keep saying that this is all relative, right? It's all relative if you compare to the rest of the market. Doesn't mean you're going to get amazing rates per mile. So I decided to compare it to a market like Utah, which is bleak, it is pale, the volume is there, but no tender rejections. So from Utah to Pennsylvania, it's $3,000 for 2,050 miles. This is a real price from the load board. Then from here to Dallas, Texas is $2,000 for 1,500 miles or so, 1,550, or so. And then from here to Colorado, about 550 miles pays $900. So yeah, Utah, a place like Utah is not a place to be. So when you're looking at this map and you have a dry van, just strive to go to the places which have a lot of volume, they're high, and also they're as blue as humanly possible because of those tender rejections. They still work on this kind of individual level, regardless of what is going on in the market as a whole. All right, now let's take a look at reefers in terms of spot volumes. How much volume is there on the spot market? So obviously we are not following the 5-year pattern here anymore. And this is most likely because produce is severely lacking. We can see that from week 23 to week 24, there was a decrease in volumes on the spot market, which of course dragged the reefer rates down. Not by much, but they did, as you can see. Now, we have been following the 5-year average for the spot rates. We shall see if these rates increase in the next 2 weeks or so. I am a little bit skeptical at this point. Even though I'm the person who's always hopeful, I'm a little bit skeptical because of the volumes, right? I just don't see it happening quite yet, and I sincerely hope that I'm wrong. All right, let's take a look at the volume map, which is a darn disaster for reefers. As a reminder, again, red means a decrease in volume from last week, blue is an increase, and gray is no change. And the height shows us the general volume in the area. The map is gray and red. That's pretty much with little blips, insignificant blips of blue. The volume is a disaster for the reefer, unfortunately. What we should be seeing is we should be seeing California blue. We should see the Texas area blue. We should see the Nogales area blue. It's not happening. It's not happening. Unfortunately, the volumes are not there. What about tender rejections? Well, this is a map that I like a little bit more because it has more blue in it. Works the same way. We can see that there was a nice increase in Idaho, in the Northeast, North Carolina, parts of Virginia. We have the Houston area, Oklahoma, some states in the Midwest. Not much change in California, nothing significant, but this is a map I like better. There were some significant increases, positive changes to tender rejections, as we would expect looking at the general market where tender rejections are on their way up. What about the head haul for reefers? As a reminder, blue means that there are more loads than there are trucks. Red means that there is overcapacity. Well, now I understand why the tender rejections in Idaho increased. There is a lack of capacity here compared to loads. Now, there is also a lack of capacity in Central California, Texas, and then it's kind of spread all over the place in the Midwest, some in the East Coast. But yeah, not much of a change from last week, I would say, except for Idaho, if I remember correctly. So where do you have to go if you have a reefer? Okay, as a reminder, again, we're looking for a place that is very tall, because that means a lot of volume, and as dark blue as possible, because that means a ton of tender rejections. And we know the more volume and the more tender rejections, the more freight is getting pushed into the spot market. But again, this is all relative. So because of the market conditions right now where the tender rejections and the spot rates are not really in balance or correlating, I decided to double check. So starting with Idaho. Idaho is averaging around $220 to $240 per mile to go out of Idaho. California, it's a good market, relatively. Most loads are over $2 per mile. I know you're gonna kill me for that. That's not a good market, I understand. I'm speaking in relative terms. Most loads are over $2 per mile to go anywhere. Now, this is a very sad thing considering that we looked at produce and how much shippers are paying for produce loads, and they're paying something like $3.40. Whereas most loads here are averaging $2 per mile. You can get $3.50 if you're going from California to Washington, Oregon, or somewhere in the West Coast. Then we have the Fort Worth, Texas area. Fort Worth is averaging between $2 and $2.40 per mile. And of course, the best loads are going to the northeast where there is absolutely nothing. Again, to compare, because this is all relative, I decided to take a market like Ohio. Specifically, I took Columbus, Ohio, to see what is coming out of there. It is bleak. There's not much tender rejections going on, and there's not much volume relatively. Most loads from here are going for less than $2 per mile. The only ones that I saw that pay over $2 per mile are going to Pennsylvania, which is just as bleak. And of course, from a place like Philadelphia, Pennsylvania, going to Sacramento, California, it pays something like $3,700 for 2,784 miles. I mean, it's insane. Or if you want to go from somewhere like Baltimore, Maryland to Dallas, Texas, which is 1,638 miles, you're going to get $1,800 for that. So that is what I'm comparing to. I understand that these markets, yeah, they're not paying well, but what would you rather? Would you rather take $2.40 per mile from California, or would you rather $1 per mile from Ohio or Pennsylvania? So this map is just showing markets relative to each other. If you're planning to continue operating, stick to the markets that are as dark blue and as high as possible, as elevated as possible. Okay, finally, we have our diesel prices, and not the best news here. Usually diesel prices are the good news during these market videos. Well, we can see as of the 17th, diesel prices decided to climb up, and they're still climbing up, more slowly, but they're still climbing up, which is a very, very unwelcome sign. I'm hoping that it's just one of those blips like this that we saw. I don't know. We will see. We'll see what happens in the coming week and whether it continues going down. Currently, diesel prices on average are at $3.95 per gallon. So at least it's still under $4, but I still don't like it. If we take a look at this diesel map right here, as a reminder, green means there was an increase in that market in diesel prices. Red means a decrease, and these gray areas is an insignificant or no change. More and more green squares are popping up week after week. Lots of Texas, a lot of the South, right? California, Washington, of course, Indiana, Montana, Iowa, South Dakota, Alabama, Georgia, Wisconsin. My God, there are more and more places that have diesel prices that are increasing, unfortunately. And that, of course, is a scary thought, considering that the spot rates are continuing to go down. The idea of earning less and having a bigger fuel expense obviously doesn't sit well with me or any of you. So I'm really hoping that this diesel price continues the downward trend. That's it for the market update. I am personally very, very curious to see what is going to happen next week with the continuously increasing tender rejections and whether they will translate just with a delay into the spot market. Because as we saw, currently the spot market is not doing well. Rates are going down. I can tell you from personal experience with the flatbeds have not been doing well. I see more and more loads that are posted for less than $2 per mile. Negotiation is very, very difficult with brokers, even in the best areas for flatbeds. And of course, when the market turns, so do broker attitudes. The amount of sarcastic laughs and rudeness I'm getting on the phone with the flatbed is ridiculous. It reminds me of what it was like when we were operating the dry van. Anyway, guys, I hope you enjoyed this video. I hope you learned something new. I'll see some of you this Sunday at 4:30 p.m. Eastern. And if I don't, have a wonderful weekend, and I'll see you in the next video.